Before considering an investment in EV stocks, we want to revisit why we find electric vehicles compelling in the first place. Then we're going to look briefly at some of the hurdles facing two promising EV stocks. We're going to start by vetting our list of EV chip companies and then deciding which names we want to deep dive on. So our reason for finding electric vehicles so compelling comes down to the low total cost of ownership thesis. So we're focused on owner economics minus subsidies. So based on someone else's research that we found believable, the average EV owner saves 50% on the repair and maintenance costs and 60% on fuel costs. That's in the United States. Now, the savings also can go both ways. So, for example, for electric vehicles, tires wear around 20% faster. So there's pros and cons. Now, the price of petrol and electricity, these are key inputs to these models. Now, what was interesting in the report, and this is from a piece we recently did on Mobileye that looked at, or it was BYD rather, that looked at total cost of EV ownership. The cost savings for a 5 to 7 year old used EV were found to be 2 or 3 times larger on a percentage savings basis from the before mentioned numbers. What does that tell you? Well, you know that when you go to a car lot and you buy a new vehicle, when you drive it off the lot, you lose like 20% to the vehicle's value. That's just what happens when you buy a new vehicle. So when you buy a used vehicle, the initial cost goes way down. So that tells you that the price of an electric vehicle to start, that initial cost of one, has a lot to do with the total cost of ownership calculation. And as you know, in the United States, without subsidies, EVs have been very expensive. Now, they're getting very cheap now thanks to companies like BYD in China. So the cheaper EVs get, the less they cost to operate, the more owners save by owning them. And having a car that's cheaper to operate is very compelling for people who live on very little. This report by Anderson Economic Group talks about the real-world cost of fueling EVs and says that they're actually more expensive than internal combustion engine counterparts when you consider for things like all costs. So they mentioned commercial chargers. Well, in emerging markets, there isn't any commercial charging infrastructure, so that equation's kind of off the table. You talk about EV drivers needing to pay additional auto registration taxes. That may be the case. That will vary country by country, but it's hard to believe that emerging markets are catching up with the necessity for EV drivers to pay their fair share when the economics of petrol and the contribution of petrol costs to road infrastructure are different in every country. So that's certainly something to be considered, but it's not moving the needle that much. They talk about cost of chargers and installation. Well, EV buyers typically use a standard home electrical outlet provided by the person that, or the manufacturer that sold them that car. Now they say that provides only a trickle charge. Well, it's sufficient enough. And they mentioned deadhead miles, the costs of driving miles to a commercial charger. Well, again, commercial chargers aren't that relevant in countries that don't have that infrastructure. And they talk about time costs of charging. Well, all the people have in poor countries is a lot of time. So the home charging method works just fine. And when you look at the growth of electric vehicles in emerging markets, where they're cheaper to operate because time is cheap and so is electricity, you see India rising rapidly here, Thailand, and other emerging markets, as I've been noticing traveling through Asia. And when you consider Asia as the largest component of the total addressable market, which is 1.475 billion passenger cars in the world, Asia is the dominant market for passenger cars, as you can see here. China accounting for a big chunk of that. So as of 2022, the number of automobiles in China amounted to around 319 million. Of the 1.475 billion cars on this planet, just about 26 million are electric. So there's a lot of potential expansion there. Going back to that total cost of ownership thesis, if we believe, especially as technological advancements increase and companies like BYD are offering electric vehicles for under $10,000 a pop, that these will become cheaper to operate and be very appealing to the world's population that doesn't live so well off as the North Americans that have been showing electric vehicles a lot of success so far, or the Europeans. Now, there are two EV stocks that we find compelling right now. You have Tesla, which is richly priced, and BYD, which is the China double-edged sword. So when we look at Tesla, we did this recent piece, Is Tesla Toast? What we emphasized in that and this other bit here we did on Tesla's rich valuation is that you're paying for more than just a car company, but Tesla's still a car company and a good one at that, even though they may see growth slowing next year as they ramp up their new production platform. Now, when we consider BYD, there's three reasons we want to invest in BYD. The first is for exposure to China. Now, you can get similar exposure to regional or country ETFs, so that could be overlooked or substituted. Then there's Chinese automotive domination. Now, this is a consumer discretionary sector, and people are fickle. So picking just one component of Chinese consumer discretionary sector, automotive, is risky in itself. And then trying to cherry pick a winner from that component is even more risky. And that's something that we concluded as we've been looking at BYD, though we find it very compelling. Then there's the electric vehicle thesis that we're talking about right now. So China may be dominating here, BYD in particular, but if current or new automakers enjoy success, we want exposure to whomever happens to be winning at any given time. So just since our last piece on BYD, we discovered a number of things. One, that there's a round lot problem on the Hong Kong exchange. So in other words, you need to spend about $11K USD just to start the minimum size position that you're allowed to. That is a barrier to entry for a lot of retail investors who are looking to dollar cost average. So you need to trade it on the ping sheets. Now, there's sufficient volume, it seems, on the ping sheet to allow for that. But what we decided to do based on feedback from our subscribers and our own internal research is look at companies in the semiconductor industry that may give us exposure to electric vehicles. Now, before we get into that, I know a lot of you out there are big fans of the Nanalyze channel and always looking to help us. Do me a favor, go right below the title of this video and click the drop down there on subscribed. And you see where you can choose all, it's the black bell. Click that, and then you can see here where it says subscribed and there's a black bell. What that will do is notify you as soon as we have a new video so that you can be among the first people to watch it and comment. That helps surface our videos and grow our channel. So please do that right now. Do us a favor and help us out. We'd really appreciate it. Thank you. So what we're looking for in an EV chip stock is a key component that all electric vehicles need. Now, it must have transformative potential. We don't want to have any sort of infotainment stuff that are nice to haves. Ideally, it would have multiple use cases, not just automotive. And when we see a segment described as automotive, we need more color than that. We need to know exactly what this component does. Ideally, it's managed to capture a commanding market share, and it has exposure to China's over 400 electric vehicle makers, which it's a very competitive environment there, and today's winner could be tomorrow's loser. So also note, and we need to be aware that some automakers may build their own components, such as BYD and Tesla. Now, when we look at today's electric vehicles, they contain a lot of electronics, and you could see some of these components here. You have onboard chargers, infotainment, as we mentioned, microcontrollers. Then you have autonomous sensors and controllers. Well, that points to a recent piece that we did on Mobileye. Now, Mobileye happens to have a 70% market share in this space, and Qualcomm and NVIDIA happen to be seen as formidable threats. And you see here we've charted Mobileye's revenues against Qualcomm and NVIDIA, but what you need to remember here is that this isn't really apples to oranges. So Qualcomm, for example, their automotive component contains other things than just autonomous sensors. Also note that autonomous sensors aren't exclusive to EVs. So when you invest in this theme, you're investing across all vehicle types. It's really a play on autonomy. Now, NVIDIA only provides 1.5 exposure percentage of their total revenues exposure to auto. So just remember that even though they appear to have a compelling percentage of auto revenues on this chart, the reality is that as an investor, you get very little exposure to that. And there's certainly the skate to where the puck will be thesis, but right now, NVIDIA is all about data center revenues or AI. Now, when we look at Qualcomm's revenues, here again you see automotive only at 7%. They talk about digital cockpits, connected services, advanced driver assistance enabled by Gen AI models. So the infotainment theme, again, we don't find as compelling. And when you look at the other revenues they have here, Internet of Things, well, we don't mind IoT exposure, but that's already our second largest niche, and IoT is a broad term. So it's pretty easy for us to dismiss Qualcomm just based on that exposure number. You only get 7% exposure in automotive. Even if that were pure play EV chip exposure, you're just not getting that much. Now, when we look at our list of candidates here, we've scratched off Qualcomm, and we've also scratched off AEHR test system. So how did we come up with this list? Well, these are the names that surface in our own internal research and in our Discord channel where our paying subscribers have surface names. And AEHR is going to be crossed off because it's just too small. We only consider companies with a market cap of $1 billion or higher. You can also see from this stock price chart here that AEHR has been pumped a bit, it seems, and you want to be very careful about that. So we see a lot of people coming around dropping this ticker. Maybe they don't even know why they are, just so many people are talking about it. You need to be very careful of the crowd mentality out there in social media with these armchair pundits. So INDI is certainly one that we want to look at, Axcelis, Allegro, ON, and NXP. Now, Wolfspeed I've also crossed out. That's because we're currently revisiting that company in our research queue, and we have an MBA working on analyzing that stock right now on the heels of this last piece that we did. And in that, we said we came away from researching Wolfspeed and liking it more than when we started. We said maybe we're drinking the Kool-Aid, but we feel the thesis is compelling enough to merit consideration in a tech stock portfolio. Since then, shares have been bashed all to hell, probably because of the problems they're having with that big factory they were building, I'd bet, but I don't know. Let's see what conclusions the MBA reaches, and that will come out as a research piece probably in the next week or so. Now, when we talk about Wolfspeed, we're talking about this silicon carbide thesis that we've covered in another piece that you can read here a while back, but it boils down to this, that the silicon carbide device market growth is going to be dominated by automotive, you can see here, and that the wafer production, which is what Wolfspeed does, is projected to double every 3 years. So that thesis is very interesting. Now, when we look at the short list of 5 EV chip stocks remaining, I've broken each down here based on the percentage of their revenues attributed to automotive. So NXP, 51% automotive, 22% IoT, 16% comms, 13% mobile, etc. You can go down and read through this list. What we need to do here is really understand what that word automotive means for each company. So when you look at Axcelis, for example, they're a silicon carbide play, but would Wolfspeed be the better way to play this? It's hard to say. We need to dig into that. And you can see they're broken down 39% power devices, 33% general mature, 17% memory. So when you look at INDI, we also want to consider, as we said earlier, exposure to China. India has 44% of their revenues coming from China, and that's growing very fast. They also had 3 acquisitions last year, and there's no revenue segmentation from what I could see. So it's 100% auto. Well, they talk about ADAS, so autonomy more or less, user experience, and electrification. We're, again, as we said, very interested in electrification. So if you don't have a diversified portfolio already, our tech portfolio is very diversified. I think there's 37 names right now. Then this mixed exposure is a lot more attractive. For us, we're looking for pure plays. And as I said, we need to understand what automotive means for each company. So we're going to do that in future pieces. Now, I'd love to hear comments from anyone, especially those who have sacred cows on this list. Tell us why that automotive component is such an important part of your investment thesis. We'd love to hear that. Also, raise any other names that we might have missed on our list. Nothing very small, please. As I said, we have that $1 billion market cap cutoff, and nothing that's too diluted like a Qualcomm. So just to conclude, is overexposure to semiconductors bad? So in our portfolio, NVIDIA is our largest holding, okay? We have some solar hardware that's going to count as semis. Now, we exited Teradyne because their industrial robotics exposure wasn't cutting it. And we recently started a new position in semis. So is that bad to have that much exposure? Well, not necessarily. We have a very large overexposure to software too. Well, is that bad? And I think the answer is, well, if you're investing in industry agnostic solutions, that helps mitigate the risk. So we don't invest in software verticals like Toast or Procore, the construction software firm. Toast is for restaurants. So we don't like verticals. We like horizontal software solutions. That helps mitigate a lot of that risk. So in our next video, we're going to dig into the 5 shortlisted names we talked about today. In the meantime, if you're looking for the best semiconductor stock, this is a very popular and excellent piece that we did on that topic. Give that a watch. Please help us out by subscribing and making sure you've checked the notifications to receive our alerts on new videos. Thanks so much for taking the time to watch this today.